again, we were asked to do this, so we're going to run through kind of how this works real quick and understanding what short selling is. How does this whole thing work? So we'll go back to how GameStop started, but this is how it all works. And so when it did start is that basically you're trading bets on shares, namely, again, with GameStop when this started. And this is, again, a legalized form of gambling if you really think about it. And you're just thinking, hey, the idea is to push the stock up because it's at a low price to start. And so when people or entities bet against a stock, that's where the shorting comes in. So shorting means that shares are borrowed from a broker on margin, and the broker says, hey, I'll give you these shares, but you need to return them to me later, and you're going to pay me margin interest in the meantime while you're holding on to them. So that, in a very short definition, is what short selling is and how it works with someone who's buying or borrowing the shares from a seller. So this means when you short the stock or borrow the shares, you want them to go what? Down. So, and now it sounds kind of opposite, but that's what I mean. Think of it as like a put option in a way. You want it to go down, where a call option, you want it to go up. So what happens is that the investor could buy the same amount of shares at a lower cost. And if that happens, the investor gets to pocket the difference, meaning I sold the shares at a higher price, betting the stock is going to go down because I don't believe in the company's stability of what I'm buying into. So honestly, this is really an age-old strategy for sophisticated investors, I would say, but even sophisticated people get burned. And there's nothing wrong with it. It's not illegal. And you just have to be fully prepared to deliver their shares back to the broker when you borrow them, because, again, you borrowed them, but you have to give them back. So basically, let's say it this way. Short selling is pretty simple in the concept. So an investor borrows a stock, sells the stock, and then buys the stock back to return to the lender. So we're just kind of repeating this, but you got to get it in your head a little bit what you're doing.
And just to interject, it's like one of the most risky trades you can do. Betting on the stock going down to have to buy back the amount of shares you sold in the off chance that it does go up. This is one of the most risky plays you can make as a trader.
Yeah, especially it's much easier, I think, to bet a stock going up than down because you can base it off news and information that's stable, where this is a manipulation of a stock to go up to push people who are betting that it goes down, especially if you don't know much about it. That's why these hedge funds have been doing it for years. When no one was paying attention, I'm sure some of them have made some pretty good money because they have, again, manipulation and time, and no one else is looking at it but them per se. And so but even that, it's like, this is just high risk gambling. You can look at it any way you want, but that's what it is.
Yeah, definitely. And manipulation.
All right, so let's do a loose example for simplicity. We'll do this two ways. One actual, one just maybe so we can get this melted in your brain a little bit. But suppose I borrow 10 microphones from Justin, and they have a value of $100 a pop. So that's $1,000 in my pocket because when I borrow them, my goal is my goal is to immediately sell those to buyers who are willing to pay that $100 for those. So my goal now is saying I want the value of these microphones to go down in market value. So if the price drops because maybe a better model came out, maybe I did my research and I think there's a new iPhone 13 coming out, for example, maybe not a microphone, something like that. And let's just say in the off chance they go down to $80 from that original 100. So that means I get $20 per each one of those microphones that I borrowed. And in this case, I can take that and now go back to Justin and say, listen, these are worth $800. I borrowed $1,000. You now owe me $200. That's how it works. And I know it sounds very backwards the way you think about it, but that's how it works.